Good evening, everyone. Thank you for joining us this evening on the second installment of the Options Trilogy. I'm Crystal, the Community Manager at ProsperUS. Let me introduce our speaker for tonight. We have Chris, co-founder of Evergrow Fund, founder of RetainWealth.com, and founder of Value Investing Mentorship Club. Some places he has been invited to speak or have added value as a mentor or writer includes Singapore Poly, SMU Institute, Sidley TV, Dollar and Cents, The New Savvy, Value Walk Blog, Investment Modes, NUS, NUS Investment Society, Singapore Financial Conference by NTU, CGS-CIMB, the Financial Coconut Podcast, Money FM, and internationally in Myanmar. ProsperUS is a digital investment service catered for the millennials. And to allow millennials to gain more insights on investing, we have specially curated webinar series. So with ProsperUS, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. Check out our ProsperUS app on Google Play and App Store today. Do follow us on our social media to keep yourselves updated on the latest news. So without further ado, let's start tonight's session. Chris, over to you.
Hi, Crystal. Thanks.
Hi.
Thanks for having me. All right. Hi, everyone. Good evening. Happy to be here. And before we begin tonight's educational webinar on options, a quick disclaimer. We do not give any financial advice. All the information here for tonight is for informational and educational purposes only. The usual disclaimer. So the agenda for the webinar tonight, you will learn more in detail about some of the purposes of why investors buy calls and put options, and also why investors sell calls and put options. And most importantly, what are the risks of doing them and what are the potential benefits? So in summary, you'll be learning about exactly what is buying and selling puts or call options, as well as the potential risks and benefits that is associated with them. So the webinar will take around 1 hour and we'll have a Q&A at the end of the webinar. So there's a Q&A kind of tool in the Zoom webinar function where you can input your questions and I'll answer it at the end. So a quick introduction about myself. I'm the co-founder of Evergrow Fund. I'm also the founder of RetainWealth.com. That is my blog where I often write investment articles focusing on value investing, on the market in general, and on options as well. So this is my educational business. I'm the founder of Value Investing Mentorship, where we basically teach people in one-to-one or in small groups on how to analyze a company, how to value them, how to have the right kind of mental models when we invest in stocks, and how to look at stocks not as stocks, but as businesses. So if you would like to find out more, you can go to vim.sg. Right. So without further ado, let's start with the educational webinar today. And let's start with why investors buy call options. Some of you may have heard of the terms of buying call options, maybe online, but maybe not many of you know the purpose of why people do that and what are the risks and the potential benefits involved. So why investors buy call options? Generally, in summary, when investors buy call options, they are usually bullish on a stock and they want a leverage kind of potential gain, but with a cap amount of loss, a cap amount of maximum loss. So when investors buy call options, they pay a fee to purchase the call options, and the fee is called premium. So when you hear the term premium paid, that means that is usually someone buying option. They pay a premium. And the premium that they pay for the option is the maximum loss that one can lose on the call option. So this is a chart from Investopedia to depict how do we generally look at the buying call options profit, right? So if you look at the chart here, you will be able to see that there is on the left hand side is the profit or loss. And then on the bottom, you see stock price at expiration, right? So that means that if the stock price at expiration is more than the strike price, then the profit will go exponentially up according to how much the stock price goes up above the strike price. And then you notice at the downside there's a cap at minus $200, right? So the $200 is the premium that investors pay when they buy the call options. So from here, you see the downside and the loss is $200 and the upside is technically unlimited for buying call options. And how do you calculate the profit, right, when you buy call options? You look at two things. Firstly, you look at the payoff. So payoff is spot price minus strike price. Spot price is basically what is the current stock price today. And then the strike price is basically what is the price that is in relation to the options contract. And the profit is the payoff minus the premium paid. So here's a quick exercise. Suppose we buy a call option of a company for a premium of $1. The option strike price is $40 and it will expire on January 1st, 2024. At what price do we break even at? So that means that at what price must the stock price be by January 1st, 2024 so that the investor will break even? So the answer to that is that if it's a strike price of 40 and then they pay a premium of $1, the break-even price is at $41. And any increase above that is considered a profit. So that means for buying call option, if let's say at the expiry date, the price is at $41, that is the break-even points. And then if it is at $45, that means the profit is $45 minus $41. The profit is $4 and it paid $1. So the profit is technically around 400%. So what are the potential benefits and risks of buying call options? So just now we mentioned that the losses are limited to the premium paid, right? But that also means that we can lose 100% of the premium that we pay for buying call options. So this is the risk. We may lose all the money that we put to buying call options. Payoff for call options is technically unlimited, depending on how much the price will rise to. That's why in the first slide, I mentioned that buying call option is when someone is bullish on the stock. More importantly, buying calls is time sensitive and it is definitely more speculative in nature. And we can easily lose 100% of the premium we paid. Because you notice for options, there is a expiry date. So the price have to go above that price before the expiry date to make any profit. If it doesn't, then you will lose 100% of the premium that you pay for the call option. So again, now if we go back to this chart, I think it will make more sense now. Okay, so feel free to take a photo of the chart if you want to. Okay, now let's talk about buying put options. So just how we mentioned, when people buy call options, they are generally bullish on a stock. When people buy put option, they are generally bearish on a stock. So they think that the stock price will go down, or they're generally concerned that the stock market will fall. So they want leverage to benefit from a down market, but with a cap amount of loss. Again, the cap amount of loss is the loss of the premium. So people buy put options. Sometimes it can be for two reasons. The first one is maybe for hedging. That means they call it protective put, or speculation. Simply you think that the stock price is too high and you're bearish on the stock and you want to short it. So one may short it using a long put. So one may buy a put option. A quick example is I think Michael Burry, sometimes ago, he bought a put option on Tesla. So that means he was bearish on Tesla some time ago, but instead of shorting the stock directly, he buy a put option instead. So when you buy any option, put or calls, you pay a fee, right? And that fee, another recap, is called premium. So the premium is the maximum loss one can lose in a put option. So if you can see here, again, the profit or loss, right? It's dependent again on the share price. So this is the chart, and to calculate it, the difference is that when you buy a call option, the profit are technically unlimited and the loss are technically, you may lose 100% of the premium that you pay, but it's kept to the premium that you pay. But for put option, the profit is actually the strike price minus the spot price. That means that the profit is actually up to the price that the stock can go to zero, right? So that means that if the current strike price, it's let's say the strike price is, let's say, $20, and then the current stock price is, let's say, $5. So $20 minus $5, that $15 is the profit. So again, going back to this exercise example, suppose we buy a put option of a company for a premium of $1. The option strike price is at $40 and it will expire January 1st, 2024. So at what price do we break even at? So we break even at, instead of 40 plus $1 is actually 40 minus $1 is $39. And any decrease below that is considered a profit up to maximum of $39, right? Because a stock cannot go negative numbers. The maximum price is zero. So like shorting a stock, the potential profit is limited to all the way up to zero. Buying a put option is the same. It's limited until the stock price goes to zero. Against the potential benefit and risk of buying puts, losses is limited to the premium paid, which also means we can lose 100% of the premium that we pay for the options. The payoff for puts is limited to how much the price will fall to, which means a maximum of until the price goes to $0. And again, more importantly, buying put is time sensitive and it is more speculative in nature, and we can easily lose 100% of the premium that we pay for buying options. And furthermore, why is that so? Because in buying options, there's this term called time decay. Time decay works against the option buyer. Time decay is the measure of the rate of decline of the option contract due to time. So actually, if the price stays the same, over time, the value of the contract will still go down because of time decay. And time decay will accelerate as the option time to expiry draws closer. Hence, when there's usually around 30 days left, the time decay will usually go up exponentially. That means that the value of the contract will go down exponentially, usually around 30 days left till the option's expiry. So some people will suggest to simply sell it or roll it into a new month. So next, why do investors sell calls? And why do investors sell options? So just now we talked a little bit about why do investors buy options. Now we go on the flip side. When investors buy options, they are paying a fee. That fee is called premium. When investors sell options, they are getting a fee. That fee is called premium. So you notice in every trade in the stock market, there's a buyer and there's a seller, right? So the buyer of the options is actually giving the fee or the premium to the seller of the options. So now let's talk a little bit about the flip side, selling call option. So generally, when people sell call option, is that when they are bearish on a stock and they want to earn a premium. For naked calls, which is selling calls without without owning the stocks, the maximum loss is actually unlimited. So when you sell options, there's actually two more types. There's naked selling and then there is covered selling. I'll cover both tonight. For naked call options, the maximum loss is unlimited and the maximum gain is limited to the premium received. So when you sell call option, you are getting a premium, right? But if you sell call options naked, that means without owning the stocks, your maximum loss is technically unlimited. So the premium is the maximum gain one can make on selling a call option. Selling naked calls theoretically has unlimited loss potential because the stock price technically can go up in a huge way, right? And there's technically no limit on how high a stock price can go. So here's some example. For example, in this example, the investor wrote a call option with a strike price of 865 and expiry of and it will expire in May 2017. And then after a short pause, the stock resumed its rally, and by mid-May, it reached 966. So the liability of this is that 966 minus 865. So the person who sell this naked call is liable in this $101 losses of difference. And this offset by whatever premium that is collected at the start. But at the start, the premium is unlikely to be as high as $101 per share. It may be just about $2 per share or $5 per share. I'm not sure. But this is an example to show that when you sell a naked call without having the stocks of the same size of the amount of the call options that you sell to, technically your loss is on the upside can technically be unlimited. And in summary, it's very dangerous to sell naked calls. Selling covered calls is selling calls representing the same size as the stocks we already have in our portfolio. So when you sell a covered call, you already have the stocks. And then when you sell calls representing the same size of the stocks you already have, you are technically promising to sell the stock that you already have at a certain price. In return for that, you get the premium, right? And if we do get exercise, we already have the stocks to sell. If we do not get exercise, there's no downside of protection, and we keep the premium. I mean, if we do not get exercise, right, we simply keep the premium. In summary, on the other hand, if you look at the naked calls here, if you don't have the stock, right, you cannot sell the stock at 865. You must buy the stock from the open market at 966, and then you buy it and then you sort of like sell it. Technically, it will result in an immediate loss of 101 per share. But if let's say you have the stock, then you will simply need to sell your stock at 865. You don't have to buy it in the open market at 966. Selling call profit, technically your profit potential is limited to the premium that you receive, and your loss potential is technically, well, it depends on how low the price of the stock goes. The break-even point is the strike price minus the premium. So for example, the shares rise to $60 and the option is exercised. So here, this is an example of simultaneously buying the shares and selling the calls. So in this example from Investopedia, the investor buy XYZ shares at $50 Then they immediately sell the same amount through options, and they get $4 in return. Exercisable at 55. That means that if it goes above 55, they have to sell it at 55. And in this case, the stock closes at $60 and the option is exercised, you receive $55. So your profit is the $5 capital gain plus the $4 of premium that you collected from the sale of the option. And that result in $9 per share of profit, or 18% from January to July. On the other hand, so that's the bullish scenario. On the other hand, if you do have the shares at $50 and then you sell call option at 55, the stock drops to $40. You still keep the premium of $4, but you have a $10 share losses, which you can, of course, realize it or unrealize it depending on the thesis that you have with regards to the company. Okay. So, yep. So this is a chart to show again how it works. So the potential benefits and risks of selling calls is that, well, selling a naked calls, theoretically you may have unlimited losses for a limited gain, the premium. And then the risk for selling covered calls are the drop in share price, can be a capital loss, realized or unrealized, for a limited gain, the premium also. So next, why investors sell put options. So just now is why investors sell call options. So in terms of put options, investors usually sell put options when they are bullish on a stock and when they want to earn a premium. So for naked put, that means that the investors sell put option without holding a short position in the underlying stock. The maximum loss is from the current price of the underlying all the way if it goes to zero. So it's the opposite of buying put. You remember? Buying put, your gain is from the current price all the way to zero. Selling naked put is from the current price all the way to zero. Maximum gain is limited to the premium received. So again, selling options, the maximum gain is always the premium received. Then for selling options, there's naked selling or there's covered selling. So selling naked puts for premium may result in losing way more than the premium, right? Because when we sell a naked put option, the problem is that they do not have the kind of, like, they may not have enough cash to actually if in case they get exercised, they may not have enough cash to actually buy the stock that they covered with. So that can be very dangerous, and they may face a margin call and their whole portfolio may actually be wiped. So here from Investopedia, it says the margin requirements are often high for selling naked puts because of the propensity for substantial losses. Because selling a naked puts, you are essentially promising the other party that you are going to buy the stock at a certain price, right? And you may not have the money. So you are just doing that to get the premium. So that's very dangerous. When the price of the stock falls below the strike price before or by the expiration date, the buyer of the options can demand the seller to take delivery of the shares of the underlying stocks. Then the option seller may have to go to the open market and sell those shares at market price loss. Yeah. So imagine the strike price is 60, the open market is 55, and in time when the options contract is exercised, the option seller will incur $5 per share loss in the stock. So this is strike price of 60, the spot price or the market price is 55. So can you imagine if, let's say, somebody sell naked puts in this market, right? They to get the premium, and then somehow the stock price from 60 fall to 20, that person is liable for a loss of $40 per share immediately, right? So it says the premium somehow offset the loss, but the potential of loss can be a lot, can be substantial, right? Because the premium is usually not that much, as opposed to the potential losses if the shares basically like doesn't go the investor's way. So selling cash covered puts, on the other hand, is selling put while at the same time setting aside the cash needed to purchase the underlying stock at the option strike price. So that means that in this case, if the investors do get exercise, the investors already have the cash to buy the stock. If we do not get exercise, we keep the premium. If we do get exercise, we buy the stock and then we also keep the premium. So just now we mentioned selling covered calls. Selling covered calls is that you sell the call options at the same size of the stock that you already own. While selling cash covered puts is you sell put option, but you have the cash ready just in case you get exercise. So this is the definition of cash covered puts. So the potential benefits and risks. The potential benefit, the max profit is basically the premium that you get from selling put options. The potential loss is technically if the stock goes to zero, right? So technically the loss can be substantial. So the lesson here is that don't anyhow sell covered put, or basically don't anyhow invest lah, in general, right? Because it can still be very dangerous. So in summary, options are dangerous without a deep understanding of the underlying company, and buying options may result in us losing 100% of the premium we paid for the options. And options in general, uh, the downside is that there are market timing involved. And the key to me, in my view, is that when we do options, ultimately how an option price move or how our trade worked out is still very much dependent on how the company behave and how the company perform. Because ultimately an options is based on the underlying stock value. So selling options for the premiums, if done naked, may result in us having theoretically unlimited losses if the stock goes up for calls, or if the stock goes down for puts. Because if the stock goes down for puts all the way to zero, and you don't have the cash, and you may be liable for all the losses up till the stock price goes to zero. If you do a naked calls, it is very dangerous because you'll be liable all the way to the price that the stock can go up to. Selling options for the premiums, if done covered, may result in us having the losses if the stock goes down also. Right. So I think in summary, buying and selling options is useful in some cases if done right, but ultimately there are risks involved, especially if we do not understand what are the risks involved. For example, when buying options, although your losses are kept to the premium, that is technically you may lose 100% of the money you invest. Selling options, on the other hand, if you do it naked, you will technically may be liable for unlimited amount of losses for call option and all the way down to zero for put options. But if you do it correctly, buying and selling options may be a useful tool in your arsenal, as long as you understand what are the potential benefits and most importantly, what are the potential risks there. Okay. All right. So thank you. And I'm sure some of you may have some questions because this can be quite an advanced topic. So feel free to ask them via the Q&A function on your Zoom platform for those who are listening through Zoom.
Thanks, Chris, for
Yep.
the presentation. So I think we have a few questions. So maybe I'll just read off the first question. So the first question is actually, what kind of options strategy does Warren Buffett do?
Okay. So for Warren Buffett, From what I read in his annual reports, he does selling covered put options, cash covered put options, because for him, I think we'll cover this a little bit more also in the third webinar. So you guys can scan this QR code to sign up for the third webinar as well. But basically for Warren Buffett, he usually do cash covered puts.
Thanks, Chris. So
Yes,
the
no
next
problem.
question, right, that we have for tonight is can we lose all of our money buying options?
Yes. So like I mentioned just now, when you buy options, your losses are limited to the premium that you pay, but you may lose 100% of that. So it can be very dangerous if you do not do it correctly lah. Yeah. By the way, guys, this is a link to my free Telegram channel. So if you're interested to stay updated for any educational investment updates from me, feel free to scan this and join the free Telegram channel. Any other questions, Crystal?
We have one more. So for the audience tonight, right, if you have any questions, you can just pop them in the Q&A function, and Chris will actually address your question live. So the next, I'll just move on to the next question first.
Okay.
Is selling options better or buying options better?
So that's a very interesting question. Um, I think ultimately it depends on the scenario that one may be at, right? With regards to currently what is the strategy there, with regards to the company or the thesis that they have with regards to the investment. So buying options in general, for example, like buying calls, the danger is that you may lose 100% of your money. But if done correctly, it may produce massive gains as well. But the danger is that you may lose 100% of your money. So then selling options, on the other hand, if, for example, you do a covered options, like what Warren Buffett is doing with a covered put options, then the key is that you must understand the company well. And I think let's cover that a little bit more in the third webinar, where we'll cover the specific strategies as well as the limitation of the Black-Scholes model, right? And how we can actually leverage on that to make money from the market.
Thanks, Chris. I believe that's the last question for tonight. Thank you for sharing with us more about options today. So to help us better understand what we can actually do better in the next session, so do scan the QR code that's shown in this slide above for us to make some tweaks to how and what we can cover in the next series, the last trilogy of the options. Yep. So thanks, Chris, and thank you everyone for joining us tonight.
Thanks, everyone. Thanks,
Thank
Crystal.
you.